Notice the pattern? Exactly 18 years apart. That's not coincidence. That's the real estate cycle, a pattern so precise, so mathematically consistent, that it's predicted every major financial crisis for the last 200 years. The 18-year cycle just completed in 2024. Right now, we're in the collapse phase. And if history holds, and it always has, 2026 is when the entire system breaks. I'm going to show you something that will change how you see this moment. Not opinions, not predictions. Historical patterns that have repeated with clockwork precision since 1800. Patterns that called the 1990 recession, the 2008 financial crisis, and are now pointing to 2026 as the year everything implodes. The cycle doesn't care about your politics. It doesn't care about the Federal Reserve. It doesn't care about AI or innovation or this time is different. For 224 years, it has crushed every generation that ignored it. Today, I'm breaking down exactly what the 18-year cycle is, why 2024 marked the peak, what the historical data says happens next, and most importantly, what you need to do right now before the collapse phase accelerates. Because here's what terrifies me. This cycle isn't just predicting a recession, it's predicting the simultaneous collapse of real estate, stocks, consumer debt, and sovereign debt, all at once. Something we've never seen at this scale. Let me show you why ignoring this pattern in 2026 could be the most expensive mistake of your life. The 18-year real estate cycle was discovered by economist Fred Harrison, who studied land values going back to the 1800s. What he found was shocking. Real estate markets move in predictable 18-year cycles with mathematical precision. Here's how it works. Years 1 to 7, recovery phase. Coming out of the previous crash, prices are depressed. Smart money buys at the bottom. Banks are cautious. Credit is tight. Slow, steady growth begins. Years 8 to 14, expansion phase. Confidence returns. Prices rise steadily. Credit loosens. Development accelerates. This is the safe period where everyone makes money and thinks it'll last forever. Years 15 to 18, the blow-off, top euphoria. Prices go parabolic. Everyone who was cautious now jumps in. Credit explodes. Speculation dominates. Real estate only goes up. Then, right around year 18, the music stops. Then, the collapse. Within 1 to 2 years of the peak, the crash arrives. Prices crater. Banks fail. Recession hits. The cycle resets. And we start again. Let me show you the receipts. 1973, peak. 1974-75, recession real estate. Peaked in 1973. Oil crisis triggered the collapse. Recession followed immediately. 1973 plus 18 years equals 1991. 1989 to 1990. Peak, 1990 to 91. Recession savings and loan crisis. Commercial real estate collapsed. Recession arrived on schedule. 1990 plus 18 years equals 2008. 2006, 2007. Peak, 2008. Financial crisis. Subprime mortgages imploded. Bear Stearns failed March 2008. Lehman collapsed September 2008. The worst financial crisis since the Great Depression arrived exactly 18 years after 1990. 2008 plus 18 years equals 2026. See the pattern? Fred Harrison publicly predicted the 2008 crash in 2005, 3 years early, based solely on the 18-year cycle. He was mocked. He was called a doomer. Then 2008 happened exactly as he said. Now he's warning about 2026, and this time, the data is even more alarming. Every 18-year cycle has a midpoint disruption around year 14, a recession scare that clears out weak players but doesn't break the cycle. It's a fake-out before the final blow-off top. In the 1990s cycle, 2001 dot-com crash was year 11 to 12. Market corrected, but real estate kept climbing until 2006. In the current cycle starting 2009, COVID in 2020, was year 11. Market dropped 35% in 1 month. Then the Fed printed $5 trillion, and real estate went absolutely vertical from 2020 to 2024. That post-COVID explosion? That was the blow-off top. The final euphoric phase where home prices rose 40% in 2 years, where everyone with a pulse got a mortgage, where Wall Street called it a supply shortage that would last forever. 2024 was year 15 to 16 of this cycle. Prices peaked. Sales volume collapsed. Inventory started rising. The smart money started exiting. Right now, in January 2026, we're 17 to 18 years into the cycle. We're past the peak. We're in the rollover phase, the 12-24-month window where the collapse accelerates. And just like 2007, most people don't see it coming because the data lags. They're looking at yesterday's prices while tomorrow's crisis is already baked in. Here's why this cycle's collapse will be worse than 2008. In 2008, we had one asset class imploding: residential real estate. In 2026, we have 4 asset classes imploding simultaneously, all connected, all amplifying each other. Let me show you how they collide. Collision 1. Commercial real estate, the Lehman moment of 2026. $1.5 trillion in commercial real estate debt needs to refinance in 2025-2026. Not wants to refinance, needs to. These loans are coming due. A building financed in 2021 at 3% now refinances at 7%. That doubles the debt payment. But here's the nightmare. Office buildings are empty. Vacancy rates hit 20% nationally. San Francisco is at 35%. Nobody wants office space anymore because remote work is permanent. So the math breaks. The building is worth 40% less than 2021. The payment doubled, and there are no buyers. What does the owner do? They walk away. They hand the keys to the bank. We're already seeing it. Columbia Property Trust walked away from their San Francisco tower. Brookfield defaulted on 2 Los Angeles office towers. These aren't small landlords. These are institutional players with billions in assets. $1.5 trillion in loans. If even 20% default, that's $300 billion in losses hitting the banking system. Lehman Brothers had $600 billion in assets when it failed. This is half a Lehman, and it's just beginning. The 18-year cycle doesn't just predict residential crashes. It predicts credit cycle collapses, and commercial real estate is the credit cycle's weakest link right now. Collision 2. The stock market bubble. 40x valuations meet reality. The Shiller P/E ratio is at 40. That's the second highest reading in 140 years of data. The only time it was higher? December 1999, right before the dot-com crash erased $5 trillion in wealth. But here's what makes 2026 different. In 2000, the bubble was isolated to tech stocks. In 2026, the bubble is everything. The Magnificent Seven: Apple, Microsoft, Amazon, Alphabet, NVIDIA, Meta, Tesla, now represent 32% of the S&P 500's total value. 1/3 of the market is 7 stocks. If those 7 correct 30%, the entire index follows. That's not diversification. That's concentration risk masquerading as safety. And the AI bubble is identical to the Internet bubble. Revolutionary technology? Check. Real productivity gains? Check. Parabolic stock prices? Check. This time is different? Check. The Internet was real in 2000. Amazon was real. Google was real. They still crashed 80-90% because valuations were insane. AI is real in 2026. But NVIDIA at 70x earnings? That's not valuation. That's religion. When the 18-year cycle peaks, speculative assets crash first and hardest. In 1990, it was junk bonds. In 2008, it was mortgage-backed securities. In 2026, it's AI stocks and meme coins. The cycle doesn't kill the technology, it kills the valuation. Collision 3. The debt doom loop, $38 trillion with no exit. Here's the number that keeps me up at night, $1.2 trillion. That's what the U.S. government paid in interest on the national debt in 2025. Interest payments are now the second largest budget item, behind only Social Security. Bigger than defense, bigger than Medicare. And here's the doom loop. High debt requires constant borrowing. Constant borrowing raises interest rates. Higher rates increase interest costs. Higher costs require more borrowing. More borrowing raises rates further. It's a spiral with no exit, and we're accelerating into it. The national debt is $38 trillion and rising $2 trillion per year. In 2008, the debt was $10 trillion. We've nearly quadrupled it in 16 years. In 2008, the government could rescue the economy with TARP, stimulus, and bailouts because debt to GDP was 65%. Today, debt to GDP is 125%. There's no fiscal space left. When the 18-year cycle crashes hit, governments normally step in with massive spending. In 2026, they can't. The ammunition is gone. The debt trap is already sprung. Collision 4. The consumer collapse. Record defaults everywhere. The 18-year cycle doesn't just track real estate. It tracks credit cycles, and consumer credit is imploding right now. Auto loans, 6.9% delinquency rate on subprime, highest since 2010. 1.73 million vehicles repossessed in 2024, most since 2009. Credit cards, $1.17 trillion in total debt. Average APR above 21%. Delinquencies climbing. Underwater borrowers, 28% of people trading in cars owe more than the car is worth. They're trapped. Here's what this means. The car payment is the last bill Americans skip before the mortgage. If they're defaulting on cars, they've already burned through savings, maxed credit cards, and cut every expense. Subprime borrowers are the canary in the coal mine. When they collapse, it signals the stress is moving up the income ladder. In 6-12 months, prime borrowers follow. The 18-year cycle's collapse phase always starts with consumer credit breaking. It happened in 1990. It happened in 2008. It's happening now. Now let me show you how these four collisions amplify each other. Because individually, each could be contained. Together, they create a cascading collapse. Loop 1. Commercial real estate. Banks. Credit freeze. CRE losses hit regional banks. Banks tighten lending standards across all categories. Consumers can't get car loans. Businesses can't refinance debt. Credit freeze accelerates defaults. More CRE losses. Repeat. Loop 2. Stock crash. Wealth effect. Consumer spending stocks fall 30%. Your 401k drops $500,000. You feel poor. You cut spending. Corporate revenues fall. Earnings collapse. Layoffs begin. More people default. Stock crash deepens. Repeat. Loop 3. Government debt. Interest rates. Everything. Debt ceiling crisis hits. Moody's downgrades. U.S. credit again. Treasury yields spike. Mortgage rates spike. Refinancing becomes impossible. Defaults accelerate. Tax revenues fall. Deficit expands. More borrowing. Rates rise further. Repeat. Loop 4. Consumer defaults. Bank losses. Credit tightening. Auto loan defaults spike. Credit card charge-offs rise. Banks take losses. They tighten lending to protect capital. Fewer loans mean less spending. Less spending means more layoffs. More layoffs mean more defaults. Repeat. These aren't four separate crises. They're four parts of the same system, all failing at the same time, all making each other worse. The 18-year cycle predicts this moment, when debt, speculation, and overvaluation all converge into systemic failure. And unlike 2008, we have no shock absorbers left. Here's what the 18-year cycle tells us about timing. The peak happens around year 16 to 18. That was 2024. The crash accelerates 12 to 24 months after the peak. That's 2025 to 2026. The bottom hits 2 to 3 years after the peak. That's 2027, 2028. We're not at the beginning. We're not at the end. We're in the middle, the most dangerous phase where denial turns to panic. In 2007, the warning sign started in February with subprime lenders failing. By September 2008, Lehman collapsed. That's 18 months from first crack to full crisis. In 2026, the warning signs are already here. CRE delinquencies at 6.6%, auto defaults at decade highs, stock valuations at decade highs, debt payments consuming $1.2 trillion. The cracks are visible. Most people aren't looking. Fred Harrison says the crash window is 2025 to 2027, with the highest probability in 2026. Not because of a prediction, because the cycle says so, and the cycle has never been wrong. Let me destroy the arguments you're already forming in your head. Objection 1. The economy is strong. Unemployment is low. Unemployment was 4.4% in February 2007. GDP growth was positive. Stocks hit all-time highs in October 2007. Everyone said the same thing you're saying now. The economy is strong. Then Lehman failed, and unemployment hit 10%. The economy was strong until it wasn't. Cycles don't care about backward-looking data. They care about structural imbalances. And right now, the imbalances are worse than 2007. Objection 2. The Fed will cut rates and save us. The Fed's balance sheet is $7.5 trillion. They're trying to shrink it. Inflation is still above 3%. They can't cut to zero without reigniting inflation. In 2008, the Fed had unlimited ammunition, rates at 5%, no inflation, clean balance sheet. They cut to zero and printed $4 trillion. In 2026, they're already tapped out. Rates at 4.5%, inflation persistent, balance sheet bloated. They have maybe 100 to 150 basis points of cuts before they hit constraints. The 18-year cycle doesn't need the Fed to fail, it just needs them to be late. And they're always late. Objection 3. This time is different. We have better regulations. That's what they said after 1990. We fixed banking with Basel I. That's what they said after 2008. We fixed banking with Dodd-Frank. Regulations always prepare for the last crisis, not the next one. The next crisis finds the gap. In 2026, the gap is CRE exposure in regional banks, sovereign debt exceeding 120% of GDP, and stock concentration in 7 companies. The 18-year cycle doesn't care about regulations. It cares about debt, speculation, and overvaluation. We have all 3 in excess. Objection 4. Real estate has a supply shortage. Prices can't fall. They said that in 2005. There's a housing shortage. Prices can't fall. Then prices fell 35% nationally, 60% in some markets. Supply and demand matter in normal times. In credit cycle collapses, nothing matters except, can borrowers refinance? Can buyers get loans? When the answer is no, prices fall regardless of supply shortages, because without credit, there are no buyers. And without buyers, there are no prices, only discounts. The 18-year cycle is not a prediction, it's a pattern. Patterns don't tell you the exact day. They tell you the season. We're in late fall. Winter is coming. Here's how you prepare. Step 1. Accept the cycle. Stop arguing with the data. The cycle is 200 years old. It has called every major crisis. It's calling this one. You don't have to believe me. Look at the charts yourself. 1973, 1990, 2008. All 18 years apart. All crashes. We're at year 17-18 right now. Step 2. Stress test for a 40% drawdown. If your portfolio fell 40% tomorrow, Could you survive? If not, reduce exposure now. The 18-year cycle crashes average 35 to 50% in stocks, 30 to 40% in real estate. Plan for the worst. Hope for the best. Step 3. Build cash reserves. 6 to 12 months of expenses, minimum, preferably in short-term treasuries earning 4 to 5%. Cash is optionality. When assets crash, the people with cash buy at generational lows. The people without cash become forced sellers. Step 4. Sell real estate if you're overexposed. If you own multiple properties, especially commercial real estate, consider selling now while buyers still exist. In 2009, sellers couldn't find buyers at any price. In 2026, you still can. That window closes fast when the cycle turns. Step 5. Reduce leverage everywhere. Pay off credit cards. Refinance high-rate debt. Reduce mortgage exposure if possible. The 18-year cycle punishes leverage. The most leveraged go bankrupt first. The least leveraged survive and buy the wreckage. Step 6. Own hard assets as insurance, gold, commodities. Bitcoin if you understand it. Assets that hold value when paper assets collapse. Central banks bought 1,000 tons of gold in 2023. They're preparing for currency instability. Maybe you should too. Step 7. Watch the signals. CRE delinquency rates, currently 6.6%. Auto loan delinquencies, currently 6.9% subprime. Regional bank stocks, early warning system. Treasury yields, if 10-year goes above 5%, crisis accelerates. When these deteriorate faster than expected, the timeline compresses. Let me leave you with this. The 18-year cycle has never failed. Not in 1837, not in 1857, not in 1873, not in 1890, not in 1907, not in 1929, not in 1973, not in 1990, not in 2008. Every 18 years, like clockwork, the credit cycle collapses, real estate crashes, recessions follow. The people who studied the cycle prepared. The people who ignored it paid the price. Fred Harrison predicted 2008 and 2005. He was right. He's predicting 2026 now. History says he'll be right again. You can argue with him. You can argue with me. But you can't argue with 224 years of data. The cycle doesn't care about your feelings. It doesn't care about your politics. It doesn't care if you're ready. It just repeats. 1990 plus 18 equals 2008. 2008 plus 18 equals 2026. The math is simple. The pattern is clear. The countdown is over. 2026 is when everything breaks. The question isn't whether the 18-year cycle will play out. It's whether you'll be positioned to survive it or profit from it. The people who prepared for 2008 didn't just survive. They bought assets at 50 cents on the dollar and became wealthy. The people who ignored the warnings lost everything. This is your 2007 moment. The warnings are here. The pattern is flashing red. The cycle is rolling over. You can believe the experts saying soft landing and no recession. The same experts who missed 1990, missed 2000, missed 2008. Or you can believe the 18-year cycle, which has never missed. Subscribe if you want to track this crisis as it unfolds. The next video breaks down exactly which assets survived 2008 and which got destroyed, and how to apply those lessons before 2026 plays out. Because the cycle is inevitable. But your response isn't. The 18-year cycle just ended. The collapse phase has begun. And 2026 is when everything breaks. The only question is, will you be ready? And please don't forget to hit the like and subscribe button so you don't miss our next video. Thanks for watching.